Angel Gurria, I want to start with the state of the global economy. We see disinflation here, there, and everywhere. Give us the measurement that the OECD has right now of a move to economic slowdown, to recession, or maybe even to Lawrence Summers' secular stagnation.
I am not predicting that there's going to be a recession. What I am predicting and what we are seeing and living is that we're slowing down the growth. We thought we were going to be closer to 4% growth in 2019, 2020, and our latest projection is of 3.5%. What happened in the meantime? The trade tensions. And why is it that we are having the trade tensions affect the prospects for world economies so much? Well, basically because when you invest to produce and you produce to sell, but if you don't know whether you can sell or you don't know what price you can sell, what tariff is going to be applied to your sales, then what happens is you don't invest. And if you don't invest, then you do not have growth. This is what is happening now, and this is the size of the impact, and this is why this is so serious.
Mr. Gurria, good morning from London. Paul Krugman was talking to us a little bit earlier on about interest rates and, the recession. He basically, put it bluntly in saying the world is worse off now than in 2007 if there were to be a crisis. Do you agree with that statement?
No, I don't. We've learned a lot, and the banking system is much more strongly capitalized. It's better regulated. It's also better supervised. But it is true that some of the capital that we had, some of the ammunition that we had before the crisis has been used precisely to deal with a crisis. And therefore, in many cases, for example, the fiscal tool, the degrees of freedom are less. The monetary policy tool, well, we've used it to the hilt for practically 10 years, and therefore you have less flexibility on that score.
Is it likely that we see a U.S. recession this year? And if the Fed doesn't have the tools, what does that mean to where we end up?
I do not see a recession in the United States. In fact, the United States is one of the economies that is doing better. And at the same time, what the Fed has done is to be evidence-based, which they said they would do, and they're doing it. And that is, if you see a slowdown in the economy, then, of course, you go slower in terms of the increases in the interest rates. So already they said instead of 3, maybe we'll be doing 2. And at the same time, you're having this very, very healthy and very vigorous job creation.
Well, Angel Gurria with us in Dubai and in London, Catherine Mann. And Catherine, I'm pleased to say joining us in the conversation as well is Mohammed Al-Arian, who's watching and sends in an immediate email for Dr. Mann. Catherine Mann, very simply here, can any kind of global slowdown, global disinflation, the sluggishness in Europe, and on, is that enough to stall or even drag down the U.S. economy? How does that reaction function work?
Well, the U.S. economy is a much more closed economy than virtually any other one in the globe. And right now, the domestic source of growth coming from the tight labor market and rising wages is providing momentum for the U.S. economy. There is still also in place government spending associated with the fiscal program that has not faded completely yet. And so if you look at the U.S. economy, it has a very strong domestic sources of growth. That doesn't mean it's immune from the rest of the world. It doesn't mean it's immune from the trade tensions and the consequences of the trade tensions. It just means that in the weighting between the two of them, the U.S. economy is growing more robustly because the domestic side is much more resilient. It won't, I think what we recognize is that, if there is a exacerbation of the trade tensions, if we get to a much broader array of trade tensions, not just China, but also potentially with Europe. Section 232 issues coming up here later in the month.
Right.
Potentially a report issued about that. You start to layer on top of each other these issues on the trade side, and it feeds back to domestic investment. Domestic investment pauses. Domestic investment pauses, just as Angel Gurria said. We were a team, back there when I was chief economist at the OECD, and that's exactly the point.
Well,
you weigh on uncertainty, you weigh on investment, and ultimately that drags down the economy.
But this is really important, Dr. Gurria, with Laurence Boone and your team at OECD in Paris. What is the state of the fat tail right now? What is our financial stability? What is our ability to withstand a set of shocks or even one shock that could be out there?
As I said before, today the banks are much more strongly capitalized, and they've been capitalized anywhere from 7 to 10 times more than they were before the crisis, and they're better regulated, they're better supervised, all these stress tests that are constantly being made. And at the same time, the world is, better prepared to deal with the bad news. What we're very bad at is dealing with surprises. And what I see here is that some bad news in the offing. I do not see very many, out of the blue surprises happening in the world economy that could really, cause a negative growth, a recession, as has been suggested. I do not see a recession in the horizon.